they could get audited because it does raise a red flag if you're always reporting losses. The IRS logically thinking is like, hey, eventually you have to make some kind of profit. If not, how are you living, right? And then also, if you want to do like get a loan, buy a house and stuff, you need to qualify. You go through underwriting. Underwriting's gonna ask for your tax information, and they're gonna see what income you have.
Welcome to Skin Deep. I'm Dr. Anna Chacon, and today we have a very special guest joining us. Get ready for some expert insights you won't want to miss.
Tell everybody, who you are, how you got to know me, and a little bit about yourself, where you're from, please.
Yeah, so my name is Jose Cruz. I'm Cuban. I came to this country when I was 3 years old. My parents actually won something called the Bombo, the lottery back in Cuba. So I basically grew up here my entire life. I got introduced to you, Anna Chacon, through BNI Group, a common colleague, a common member of the group. You reached out to her, asking her how you were looking for an accountant, and I just happened to be a part of that same BNI group. So she connected us, and we had our calls, and we just clicked, and we saw that there was a possibility of us working together. I got started in accounting in a very unorthodox way. Fresh out of high school, I actually did an internship over the summer at an accounting firm locally to kind of see and get my feet wet because I wasn't sure what I wanted to do. And then I fell in love with it because I saw how the potential in accounting with everybody, bro, both in individuals and businesses, because accounting is like the language of business. So I saw myself be able to provide valuable resources and information to a lot of people, especially small startups and small businesses, and a lot of individuals that are like immigrants, like my parents, that didn't have the same resources that like you and I did growing up here, knowing the country, knowing the system, knowing the language. So I wanted to be able to kind of bridge that gap for them and be able to provide them this big firm quality at a smaller, more scalable, achievable person and firm.
I didn't know that you were born in Cuba. Cool. That's really cool.
Yeah, I came when I was 3.
How did you get into, just, offshoot question, but how'd you get into BNI? Who introduced you to that? How'd you hear about it? I myself didn't hear about BNI. And why would it maybe be something our listeners would think about?
I got into this BNI because like I said, I started my business and I kind of wanted to gain access to business owners and other professionals that I can use to build my network, right? So actually somebody reached out to me, another young financial advisor reached out to me via LinkedIn and like, hey, I saw that you started your own firm. I think you would benefit from attending this meeting. So I went to that meeting, but they already had a CPA. But then somebody else in that meeting said, hey, you should join this other meeting. So I went to that other meeting. They already had a CPA. And then that's where I got introduced to Maria, which is a common colleague that we have. And then she brought me over to her chapter that was also looking for a CPA. And I think BNI so far has been great for me because like it really connects you with a lot of people, a lot of professionals. You kind of grow this book of business for yourself. In my kind of role, accounting, law, financial advisors, is very much of a trust type of scenario. You have to create this trust and be very transparent with your clientele, and also with other professionals that you can like work off of. Like I used to work a lot with attorneys, older CPAs, older attorneys. They already have their set people that they rely on and they work with. So it's very hard for them to deviate from that. So I wanted to join BNI young to kind of grow my own network of young attorneys, young realtors, young other professionals that, we can grow together. Later down the line, we build these connections early on, and they're strong connections that we've known each other for years. And it's a better, like more business can flow among us, and we just go together. We help each other's businesses grow. That's kind of why I want to do it, to create my own little book of business and my own connections.
What are some of the most common tax mistakes you see in individuals and small businesses?
Yeah, so the most common one that I've seen is abusing the Schedule C. So Schedule C is basically where you report like your small business income, or you're a 1099 employee, or you have a small side gig or something. You report that profit or loss on Schedule C of your 1040. But a lot of people, especially the 1099 workers, they really abuse the system in a way that I think is going to eliminate it for all of us. Like when something is too good and you abuse of it too much, eventually somebody's going to take notice and they might take it away for everybody for good. And the reason why I say that is because I've seen so many different things on like Schedule C, because people go to different accountants. Some are shadier than others, some are still professional, but they put all of these things that are not always necessarily the most truthful things in this Schedule C to create these big losses and offset these losses. And there's ways to do that legally, but I've seen other people do it in ways that I know are not legal or not ethical. And that creates these like big losses, and then these people getting these huge refunds that then jeopardize them down the line, because especially when they want to buy a home or something, you know, you need your tax return to qualify. A 1099 pay stub is not going to cut it, right? So at that point in time, you're faced with a decision like, hey, I have to amend my return. It's gonna cause a red flag to the IRS. Have to pay all these taxes, all these bills, all these penalties, right? And then it just kind of ruins it for everybody, because then everybody expects that to be the norm. You know, they expect everybody to get like these gigantic refunds, and they don't know what it takes, what's being put on those returns, you know, to be able to get those big refunds. And then when the IRS comes knocking, because they're big refunds and they have a pretty good idea of like what to expect on your return, you know, then they start freaking out because they just don't understand what's being put on the return. They just trust that they give it to the preparer. The preparer is doing the right thing, and not always. They don't always do that, and then that comes and bites them in the foot later on.
How does it bite them in the foot? Do they get audited by the IRS? Like
it
what?
could, like they could get audited, because it does raise a red flag if you're always reporting losses. You know, the IRS logic, you thinking is like, hey, eventually you have to make some kind of profit. If not, how are you living, right? And then also, if you want to do like get a loan, buy a house and stuff, you know, you need to qualify. You know, you go through underwriting. Underwriting's gonna ask for your tax information, and they're gonna see what income do you have. And it's the same thing. Like, are you always making a loss? Like, you know, and then at that point in time, if you want to like correct it, then it can still be done, but then it's gonna raise even more questions and point even more red flags at you unnecessarily for something that could have been avoided, you know? And people don't think down the line, they think of like now, right? They don't wanna deal with it later, but later on when they have to deal with it, they have to go back and fix it, and that can create an issue and bite them in the butt.
Well, really funny. So there's actually people that they just report losses. That's all they do, kind of in their business.
Yeah, there's people. Yeah.
Oh my
Yeah,
God.
there's people that have W2 jobs, and then they create this fake Schedule C that they do like tutoring services, or even like Uber drivers and stuff like that, which you can still take Uber driver like stuff, but they just abuse it, right? They abuse the system. You can be savvy and like, you know, take advantage of the tax system. It's meant to do that, but you can't be abusive and greedy and put false information there, right? And there's these people that are like, they're making like 40 grand on like their W2, then they report another 30 grand on like side income, and then they put 60K of losses. That creates a 20K offset, a 20K loss that they can use to offset the W2 income that they're being withheld on, so they get all that money back. Which, if you have justice or like reasons to prove it and justify, that's 100% acceptable every side whenever it's justifiable. But most people don't have the paperwork or the justification to create these big expenses and these big offsets. And I've seen that a lot of times on the return, especially some of these tax preparers, they put self-prepared on the return. So even though you pay them, they put self-prepared. So if anything happens and you want to go back at them, to the IRS, it looks like you did it. Even if you paid them to do it, it says on the paper self-prepared. So that's a big thing that I've seen a lot of these individuals make, that they don't catch, you know, these mistakes, that you're paying somebody to perform a service. You want them to be able to give back you up if anything happens for that service. You know, you want to see their name there, their PTIN, you know, something that gives you peace of mind that, hey, if this goes south, I can go to you to help me out. And a lot of people don't do that. They see self-prepared on that, and that's it. You're on your own. So that's a huge mistake that I've been seeing a lot, especially in the small business South Florida area. You know how South Floridas are, a lot of Latinos. You know? So I see that a lot in our community. I try to explain to them.
I never even heard of that. So people
Yeah.
just kind of create a business, make it a loss, and they get a huge tax return. Wow.
Yeah.
I mean, yeah, I guess these are ideas that I've never even thought of. And the Schedule C is, what do you mean when you say Schedule C? Because I never heard that term before either.
Yeah, so there's different schedules on your return. Like there's a page one. There's all on your individual return on the 1040. So there's a page 1, page 2, right? And then there's different schedules, Schedule A, B, E, right? Like on Schedule E, you put like any rental income you have. There's certain schedules that the IRS puts out where you put and you report certain information. In the Schedule C, the information that you report there is profit or loss from a business. So if you have a side job, a side hustle, if you have 1099 income, this is where you would report all of this information, right? So that's where you would report, like, I have an office job, I have a clinic job making W2, but on the side, I do tutoring. On the side, I clean houses. On the side, I do bookkeeping, right? these little side jobs, that's perfectly normal to do. Even if you do like construction job, handyman jobs on the side, that's perfectly fine to do, right? But I see a lot of people putting like they do medical services on the side, or they do like tutoring on the side, and like I just know them and I know how they live, and like I see like the justification. I'm like, this is like, I asked them for tax returns for prior year, because what I always do, I always like asking for prior tax returns whenever a client comes to me, because I like seeing what they have going on in the past. That kind of helps me dictate the future, right? 1 year from the next, it should the tax information shouldn't really differ that much, unless you did something like, hey, I just finished med school, I'm about to get paid, right? I know that, and you're also expecting that. But like from 1 year to the next, unless it's a big drastic change, there shouldn't be that many like changes, right? So I like looking at last year to kind of see how their situation is, and I see these things, and I ask them, like, hey, what is this? What is this appreciation? What are these contractor expenses that you're reporting? What is that? And they have, I don't know, I have no idea what's that. So that's why I already know that, hey, you don't know what's on your return. You just give it to somebody and then you just want a refund. So you don't know what's on your return. You know, it's not if you come to me, I'm gonna do it the right way. I'm still gonna maximize your savings, but I'm gonna do it the right way because I have a license to protect. And you may not like the result. So I just try to explain to them and have them understand why what they did was wrong, or like how it can affect them later on the line. Because you can never get audited by the IRS. It's like a roulette, but you could also get audited. So I just want them to like know their risks and like the potential of, you might get audited, you might not, but you know, just I want to inform you of what could happen, just because I know you don't really know what was put on your return, and that's your name and your social on the line.
So accountants, can they get in trouble for, let's say, these accountants that help people with these huge tax returns, or
Yeah,
what
they can
happens?
get in trouble. So every accountant or every tax preparer has to file with the IRS and get a PTIN. It's like a code that they give you for every preparer that basically links you to the IRS. It lets the IRS know, hey, this return came from so and so, right? That's usually linked to a CPA license or an EA license certification with the IRS, right? And that's what it's on the line, right? So if they see that constantly, a lot of these returns that are being submitted with this PTIN number are having these issues and are having these conflicts that keep raising the red flags to the IRS, eventually they're gonna go to the preparer. And also, taxpayers have a very liable legal defense where it's like, hey, I relied on the professional advice of the person that I contracted to do my taxes for me. And that's a very legal, justifiable advice. The problem comes for those taxpayers is if it says self-prepared on the return. If it says self-prepared on the return to the IRS, even though you paid somebody and you relied on their expertise, you didn't catch that. They didn't put their information on the return. So for those, it's kind of hard to justify like, hey, I relied on them. But for those that do put the PTIN and they still put the wrong information, the IRS can definitely come challenge you and can take away your license, can take away your EA certification, and can like ban you from performing certain tax activities, you know? So yeah, there's definitely ways for people that is to, there's cases all the time on the DOJ versus so-and-so of the IRS going, or Department of Justice going against these bad preparers that are inflating certain expenses incorrectly and are evading taxes.
Wow. Department of Justice. Yeah, we really don't want that.
Yeah.
And then can you walk us through the process of a business valuation and why it's important?
Business valuation is a little more niche. I used to do forensic accounting at a regional firm here in South Florida, top 100 firm. So I got introduced to business valuations, and they're very neat because they kind of, it's like when you go buy a house on the market and you're like, hey, this house is going for $1 million, this house is going for $500,000. An appraisal comes and they say this house is worth this much, and they place a value on it. It's a subjective number, but it has some kind of reasoning behind it that is back that you can back up and like support that number. It's the same thing for a business valuation. The only difference with a business valuation is that businesses have both an intangible and a tangible side to them. So they have tangible sides, like for example, they have an office building, they have machinery, they have employees, right? That's the tangible side of the business. But they also have, like in your case, in my case, the knowledge, the like what we bring to the table. That's an intangible aspect of that business, the trust that like these clients, these customers rely on when they go to you. So a business valuation helps kind of value what this business is worth, taking into account both the tangible and intangible side of things to come up with a value in case you want to like either sell the business, buy another business, estate plan, right? You want to pass down your business to somebody, you're getting a divorce, and now this is a marital asset that needs to be split up, or you have other partners that you're trying to buy out, right? You need to know what this business is worth to be able to properly pay them out and buy them out, divorce, like separate the asset, right? So it comes very handy for a lot of these situations that people don't always think, and like exit planning. And what it really is basically you go through like these professional guidelines from AICPA and NACFA, right? And the IRS even, and they say that you got to value a business using primarily 3 different methods, which is you gotta approach them and consider at least 3 different methods, which is the income approach. How much income is this company generating? That could be used as a source to measure its profitability and how much it's worth. You can also value it being how much assets does it have? Is it a holding company that just holds a bunch of investments for you? And if that's the case, then the majority, it's not generating profit. It's generating like, this is what it has under its portfolio. That's the worth of that business. Or you can look at the market approach, which is like, what are other companies that are similar to this selling for in the market, both in the private market and in the public market? Like publicly traded companies. If they're comparable enough, you can say, well, if X company that's publicly traded on the New York Stock Exchange is selling for this much a share, my company that's also very, very, very similar to that could sell at that exact same price, even though it's not public, right? So you gotta consider these 3 different methods, and then you come up with a value, and then you justify this value with like looking at industry and economic reports and data, plus historical and projection personal financial information of the company, because every company is different, right? So you got to look at where they've been, where they're going, where they think they're going, how the market and that industry is doing, and you kind of combine all of this stuff in a big pot, and then you produce a value that then you justify, and then they can use to support any gift tax returns. If you're giving somebody like business interest, you're gifting your niece or your son some business interest, that is a reportable tax event they got to file a gift tax for. But you got to know what that number is, what's the quantity, right? So that's where this business valuation will come into play, and all these different scenarios.
What are some tax saving strategies that real estate investors should be aware of?
There's 2 types of property. There's a personal property and an investment property, right? Your personal property, you buy and you live in it. That's your personal residence. If you live in it for 3 out of 5 years, that qualifies as your personal residence. When you go sell it, there's something called exclusion. A primary residence exclusion. So, you know, if you're married or single, you can exclude up to a certain amount of that capital gain. So it's non-taxable. So if you sell it within an amount that capital gain falls within an amount, then whatever that sale is tax-free to you, no income taxes. For the investor side, the biggest one is depreciation and doing a 1031 exchange. Depreciation is basically just taking the expense of this property over a certain period of time, usually 27 years. And then a 1031 exchange is if I have a property that's for investment and I want to sell it. When I sell it, I'm going to have to recognize a capital gain, and the primary resident exclusion that I talked about earlier doesn't apply when it's an investment property. So that's when you do a 1031 exchange, which basically is whatever capital gains I'm going to pick up from this property, I'm going to apply it to this other property. That way, I never pick up that gain on my taxes, so I never have to pay taxes on that. But with a 1031 exchange, there's certain rules to follow. You have to identify, the whole transaction has to happen in a certain amount of time, and you have to identify certain properties within a certain amount of time, and you have to involve a third party called a qualified intermediary so basically you can never touch those funds. If you touch those funds, then that automatically makes it taxable. So you got to involve all of these people, and you got to really plan them out for them to fully work. You know, a lot of people have that misconception. They just say, hey, I'm gonna do a 1031 exchange. Yeah, before you even think about selling the property, you gotta think about, okay, who do I gotta contact to be able to do the 1031 exchange, right? Because it does require steps to be able to do it properly. Those are the 2 biggest ones to avoid the capital gains and to, you know, get a big tax deduction on your taxes.
So you said you can't touch, I'm confused. You can't touch what? And then
so like
to involve necessarily.
Yeah, so like accountants, lawyers, could be qualified intermediaries. They have to have like a certain designation that makes them qualified intermediaries, and they can't they have to be unbiased, meaning they can't have serviced you within the last 2 years or so, right? They have to be completely unbiased. And when I say that you can't touch that money, is like if I sell this house A for $100,000, right, and I'm gonna get a capital gain of 50, I cannot touch that. My bank account cannot touch that money. That 50 has to go to the qualified intermediary's bank account, and he or she's going to hold it for you until you identify your new property, your new investment property, and then she's going to pay that 50K, or them, they're going to pay, they're going to apply those 50 grand to that new property. So on your behalf. So they're doing it like if you did it, but you physically never have possession of that cash, of that money. And by doing that, you never have to pick up that capital gain because it was never under your control.
This is something I always wondered myself. How does working with the CPA, how is that different from working with a traditional accountant or tax preparer?
Anybody can prepare a tax return up to a certain point. So like you can do a tax return up to $1 million and you don't have to have a CPA designation or anything, right? And there's also EAs, which are just as qualified. However, EAs are more specific for tax and is an IRS designation. The benefits of working with a CPA is that we have to be, it's a national exam that we have to pass similar to like doctors and boards. We have to have a lot more educational requirements and credits to be able to even qualify to sit down for that exam. And once you do, the exam is so comprehensive that it doesn't only talk about taxes. It also talks about, you know, accounting and auditing. If you have a big company that you need to make sure that you're following up to a certain accounting standard. It also talks about other economic issues and like how that applies to a business, right? So we're a little more well-rounded than a regular tax preparer or an EA that may only do 1040s or may only deal with IRS tax returns. So we are a little more like a one size fits all, one-stop shop for a lot more financial partner. Like we're more of a financial partner than just like a tax partner, right? We can offer a lot more services than just tax. We can also do taxes. We can go beyond taxes. But requirement wise, basically a lot more educational requirements and a little more stricter guidelines to follow and to get licensed with the state. Plus, we also have to maintain more CPEs every 2 years than like an EA would. For example, EAs have to maintain a certain amount of educational credits to maintain their certifications. We have to maintain more than that for the reason that we're more of a full financial partner than just a pure tax partner.
What is an EA? That's the first time I've heard that term.
Yeah, an EA is an enrolled agent. It's basically a certification or a designation with the IRS that allows you to file tax returns on behalf of the IRS without necessarily having to have all the strict requirements of a CPA, right? But they're very strict with taxes because there's a designation issued by the IRS. So it only relates to taxes. But a CPA is by NASBA, which is monitored by the AICPA and the FASB, which are all big words and very technical. But basically, it's like a lawyer, like a doctor, right? You get a license with a state, and then you can practice in that area. And you're more well-rounded in taxes, in accounting and financial presentation, and auditing and economics, right? You're more holistically, you're a better financial partner than just someone that's purely just tax. They're both great, and they can both do the same thing when it comes to taxes. They can both prepare returns up to whatever, but everybody tends to specialize. Even if you're a CPA or an EA, we always tend to find our niche in our specific client base that we just understand more and we gravitate more towards. So I would say, you know, whether you're doing a CPA or an EA, find somebody that really understands your industry or at least the level of business that you're at. You know, you don't want to get somebody from like KPMG to really handle your small business because they don't have that. Even though they get a lot of exposure, they're getting a lot of big company exposure that your company may not necessarily fall into that realm, right? So that's the difference, but they're both qualified for taxes.
What are some simple financial habits that can make a big difference for entrepreneurs?
So the biggest one is keeping track of everything, of your expenses. I know everybody keeps track of their income because, you know, they got paid and everybody looks for it to get paid, but they always forget to, you know, what the offset is to that income. And you need that for taxes. And it's really hard. You come to me at tax time and you're like, hey, I made 80 grand. Great. What do you do? Oh, I'm in construction. Awesome. I know you have to buy tools. I know you drive around a lot. I know you have a truck. Give me that. Give me those reports. And they're like, oh, I don't know. Right. And then it's hard for me to kind of help you out and like bring down your income. And I really want to, and you should. Right. So the biggest thing is kind of QuickBooks account, whether it's on an Excel, QuickBooks, something, kind of track of everything. Because the only way you can actually scale a business and grow is if you track everything. And if you track everything, then you know where you can take advantage of in the tax law. That's the biggest thing that I've always seen. People don't track their mileage, they don't track their expenses, they don't track their meals, they don't track their tools, right? Tracking it is the most important and crucial thing for any small business.
What tools can people use to do that? Because, for example, I think I told you, an accountant, old family accountant, and I have never been told to use QuickBooks. I started using it last August. It's been about a year since
Yeah.
QuickBooks.
So small businesses, like I would recommend QuickBooks. There's a bunch and a ton of accounting softwares out there, but they get overly complicated unnecessarily. The most easiest user-friendly one that I found is QuickBooks. It's very simple to use. You connect your bank account, and everything that happens on your bank or credit card side gets automatically downloaded to QuickBooks. And then from there on forth, all you gotta do is just log in, whether it's yourself, your partner, your sibling, accountant or a bookkeeper that you hire, and you gotta go in and categorize it properly, and it's gonna create these financial statements for you that are gonna be needed for bank purposes or for tax purposes. But you can also create rules in these QuickBooks files that, if you're always shopping at, like, if you go to Starbucks every morning and get a coffee, before work, or you go have lunch at the same place, you can actually put a rule in QuickBooks saying, hey, whenever you see a charge from Starbucks, this is going to be a meal. There's going to be a deduction. So automatically it'll learn that and it'll do that for you. So you have to do less and less and less. But at first it doesn't know you. So you have to really be baby steps with it. Tell it, hey, I do this, I do that, I spend here, I spend there. But over time, it'll learn you and it'll automatically help you categorize things a lot better. It'll recommend where the expense should go because it learns you. And that's the easiest, most inexpensive one that you can actually do it on your phone or on a laptop. And then for tracking business miles, like if you drive a lot, there's an app that you can actually download on your phone that actually tracks where you've been and how much it took you to drive there.
Wow. What's the name of that app?
I don't know. There's a few. If you look at business mile tracking app on the App Store, there's a few that come out. They're all pretty good. Some are free, some are not. But the whole purpose is for it to track where you've been, because that's another thing that you can get on your tax return, especially if you're a solopreneur or like a 1099 self-employed small business. You can get a deduction for the mileage that you drove for business. That's a non-known, and that's a paper law. So it's not like an actual expense deduction. It's like a paper deduction, kind of like depreciation. So there's no actual cash flow that has to leave for you to put that on your return. So that's a huge one that you can do without having to actually spend money.
And how much money can you deduct for mileage?
So there's two ways to do it. There's the standard rate, which is like a predetermined expense per mile that the IRS they take, similar to the standard deduction. So if you have 2,000 miles in a year that you drove for business, you can say, hey, I want to take 65 cents per mile, which is like my home where the IRS is at. I want to take 65 cents per 2,000 miles that I drove, and that could be your deduction. I believe it's limited to about 1,500 or so, or 1,300. I have to double check. It gets adjusted every year. Or you can take another one. Like if I drove 2,000 miles in a year for business, but in total I drove 8,000 miles in a year, right? You divide that and you get a percentage. That percentage is your allocatable business use percentage. And if you have a lot of tire changes, if you have a lot of maintenance on your car, parking, right? You can add up all of those deductions that you did, and you can take, even if they're personal, and you can take a business, that business percentage, you can apply it to all of those deductions, gas. And that can also give you another deduction that you can put for the actual personal deduction or expenses that you spent, because you determine what's the business use of that vehicle that's both personal and for business. So if all of these deductions, if all these expenses that I spent on my vehicle, if I spend $10,000 on my vehicle, and I can take 20% of it as business, out of that 10,000 that I spent, 2,000 is a business deduction that I can take.
I thought you could deduct all your gas for business if you used a car that was like,
yeah, if you track it correctly. The problem is, if you're using a personal account, how do you know what's business gas versus personal gas?
But if you put it on a business account,
ideally everything there should be business.
Yeah, but you're saying to go a step further and get one of these recommended apps so you have an actual proof.
That's only if you if you use your personal vehicle for work purposes and you're self-employed. I would definitely recommend getting these apps, especially if you invoice people. You can also put the address on that invoice to help you keep track of where that invoice service took place. Because a lot of these solopreneurs, like 1099 individuals, they don't necessarily have a separate bank account for the business side of it. Their paycheck, even though it's 1099 and it's contractor, is going to their personal, right? So they need a way to kind of parse out get a business benefit for that. right? So this is a way to get the business benefit for people like that. You have a full established business and you have a separate business account. In theory, everything that you run through that business is 100% deductible because that's a business deduction. But if you don't have that, you're like a barber, you're like an RBT or realtor, right? That you're very 1099. This is a viable option for you to take some kind of benefit for your mileage.
And then how have recent tax laws impacted clients? What should listeners be aware of for the upcoming year?
I think the three biggest takeaways from the big beautiful bill, the new one that Donald Trump just passed, is the energy credits that before Biden put it into place. All these renewable energy credits for solar panels and EVs are going away. They're repealed, so you have up until September 30th to really take advantage of these. Another one is the whole no tax on tips. A lot of these people, if you're making a certain amount, you want to see that big of a benefit. But if you think about the majority of people that are waitresses and waiters and barbers, right, they're within that $50,000 to $70,000 annual range. If you can wipe off $25,000 of their income, that's a big chunk of their income, right? So that allows them to keep a lot more money in their pockets. And then the main purpose of the bill, with the whole tariffs that he's putting on these other companies for importing over here, and you're gonna pay a tax on whatever you import. So he wants to basically incentivize people in the US to kind of like invest in the US and produce things in the US. So one way that he's helping incentivize businesses is he brought back a bonus depreciation. Bonus depreciation, what it is basically a method of accelerated depreciation. So basically the IRS lets you, when you buy an asset, the IRS lets you take the full benefit, the full value of that asset in its earlier years. That's what bonus depreciation basically is. But over the years, it's kind of been phasing out. Every year it's been phasing out. So you're going to take 60%, 40%, and so on. But now he brought it back for 100%. What's his purpose of that? He wants you, the business owner, to go out and buy that equipment that you need to produce that product here and not have to import it overseas anymore. And if you buy that equipment this year, you can take that full deduction this year and that full benefit on your taxes to help offset whatever additional cost it might cost you now to employ more people to man that machine, that equipment. So construction companies, manufacturers, anybody that really has an asset, you can take full advantage of that this year. Even medical professionals, if you buy an equipment, if you buy furniture for your office, you can take that fully this year. If it was placed after a certain day in January, I forgot the exact date, but ever since it was placed after that certain date in January in 2025 and moving forward, you can take that in the year that it was placed 100%. You buy $100,000 machine this year that you need to be able to see clients' eyes or whatever. That's $100K deduction that you can take this year. And you didn't pay it because you might have financed this machine over I don't know how many years, but you can take that full benefit this year. So that's a big incentive that he brought back with this new law. And a lot of business owners should really be aware of that to really take advantage of that, because depreciation is one of the most underused tools in taxes, especially at the lower scale businesses, and it could be a huge game changer because it's all paper losses. It's basically a paper loss. You don't have to actually pay that cash. It's just a paper loss that an expense on paper that you're putting.
And you're saying this is really important for like medical devices and stuff. What was it before the big beautiful bill? Like you could not take that all in
No,
one year?
you can take it, but it was paid, but it was limited. So there's a certain percentage that was limited. Like I think it was like 60%. So you're going to take like 60% of it, or like 40%. I forgot. And there's different tiers of like equipment, furniture, vehicles, right? There's different categories of assets, but you can only take a certain portion of it. But now what he brought back and he made it permanent is that you can take 100% fully in the first year that you buy. So there's no longer that portion of like, hey, I'm going to take only a portion of this full expense. Right. No, now you can take the full benefit of it this year or in the year that you place it in service.
What accounting technologies or tools, we talked about QuickBooks, what other ones do you recommend for small business owners?
There's also an app that keeps track of your receipts. So you take a picture of the receipt whenever you go out to like a meal or something that you want to justify that meal. There's an app that tracks all these receipts, these pictures on this app. So you don't have to actually have the pictures or like the actual receipts handy. There's a lot of these things, but I basically recommend, using some kind of accounting software. And if you don't want to pay for QuickBooks or can't pay for QuickBooks, then have it on Excel. On Excel could be on your phone, notes, just kind of an electronic way of keeping records, whether it's through an app like the mileage app. You put, hey, I'm driving from point A to point B. Whether you use this app to maintain and track all of your or store all of your receipts, or QuickBooks or another accounting software, cloud-based software to kind of track your accounting. If you don't want to do that, then go basic and go Excel. Go Excel, track it, go on your notes on your phone, use your camera. Any type of way to better track yourself, whether it's through an app that are very convoluted, very expensive, very, very simple, or you go literally, everybody has Excel nowadays, everybody has Word, notes on their app, on their phone, right? Just use that, whatever's most convenient for a lot of people. A lot of people are very much on their phone all day. Use the app, use the notes app, find whatever app on the app store. There's a bunch of them. Hey, what can I use to track my mileage? What can I use to track my expenses, right? Out of the top of my head, I mainly recommend those three, which is like the mileage app, the receipt app, and then QuickBooks.
What is it about QuickBooks that you guys like? Because I hated it at the beginning. It was like Chinese. I was like, what is all these connections? At one point, I couldn't even log in. I didn't even know what to do. But what is it that makes it so, cool to accountants or so handy for you guys?
I guess to accountants, to me, I see it more around like the technical side of it. So like, I don't see, when you get paid, I don't see it as like, hey, a deposit or as an expense or a payment. Right? I don't see it that way. I see it as more of a debit or credit. That's how they taught me at school, right? Everything in accounting has two sides to it, debit and credit. But what makes it so good is it's relatively inexpensive, right? It's a subscription and it's relatively inexpensive to a lot of people, us business owners, right? It's I think the max that it goes is like $270 a month for like a Mac Daddy version of like the software, which not everybody needs. So that's one thing, the price. And the other thing is like for a lot of people that are not very like accounting savvy or like these technical terms savvy, like a debit, right? It's very plain English. Like you got paid, it says received, money received, money in, money out, a bill. Oh, I got this bill in the mail. Let me register the bill. Oh, what are my expenses? Oh, how much, like who do I gotta pay? People who owe you. There's like literally a section that says people who owe you, people who you owe. If you click on that, it will give you a report like, hey, these are all the vendors that you have still pending, right? So I think not a way why a lot of business owners like it and why we recommend it is that it's very plain English. You know how finance people, they use like these very fancy words for like all of these terms for a stock or like a penny stock or whatever. Like they're very complex terms sometimes in business, but I think like QuickBooks per se uses it very, very, very dumbed down. Especially like it's meant for smaller firms, smaller companies, because other accounting software, they require you get a financial dimension and start breaking things up in this more convoluted way, and it's a lot more not user friendly. QuickBooks, I think the most not user friendly thing in QuickBooks is creating a journal entry. That's purely debits and credits. But the rest of it, you can record payments, you can see your invoice, you can send invoices. So it's very plain English and it's very accessible to the average Joe Doe, I think.
How does Cruz Tax and Advisory Group support the needs of the South Florida community and abroad and beyond, especially for bilingual clients?
Like I said earlier, we came from like an immigrant background. My parents came to this country. I was 3 years old. I remember they used to give me letters in the mail when I was 9 years old. Cause I spoke English. And like, what does it say? And I'm like, I have no idea what this says. I'm 9. Right. So I feel like I wanted to give this same like feeling to like, there's a bunch of immigrants and a bunch of like, people that came from other countries that are business owners and they make money and they're trying to hustle and like, get a better life. And they still need to have access to people like myself, like yourself, like lawyers, right? That all these resources that these big firms have, like people that have been here for years have, and they may not always necessarily be able to achieve those people because of the money or the language barrier, right? So what I wanted to do is kind of bring that down to home. Like me and my wife, we started this. We both worked in public accounting, big firms, global firms, national firms, right? Multi-million-dollar firms, that we saw how it is in those firms. And we have the experience, we have the credentials, we have the knowledge. Why not bring it down to our community, right? And help these mom and pops that still need it. Like they're still paying taxes. They're still, they're still always trying to save and explain to them like, hey, you're making enough money now where an S-Corp might make sense. This is what that is, right? Hey, you should consider investing in retirement. This is what you should do. Talk to this person, right? I feel like I wanted to give them that big firm feel for a very low more attainable price to them. And also, since I'm bilingual, it doesn't matter if they may speak broken English to get by, but on a day-to-day, they speak Spanish, right? I speak fluent Spanish, so same as my wife. So it's an easier language. There's no language barrier, right? It's easier for them to talk to me. And also, I feel like a lot of the new entrepreneurs or the new people that are up and coming are younger. I think since I'm on the younger side, I'm a little more relatable to the new up and coming generation, right? Than like an old CPA that's sitting behind their desk, doesn't really answer emails, or doesn't really call or text you. I think I'm a little more relatable to them. They can talk to me. I'm like more plain English, more like, hey, I saw this TikTok about this guy talking about taxes. Is that true? And I can answer, right? And like an older gentleman. So I feel like we're more relatable, and that's kind of why I wanted to bring it to South Florida.
What is the advantage of an S-Corp? And you mentioned something interesting. Do you need to make a certain amount of money to have an S-Corp?
Yeah, so there's two types of taxes that every business owner gets assessed: income taxes and self-employment taxes. The income taxes is a tax bracket that everybody knows, and then self-employment taxes is 15.3% flat rate on whatever net profit the business is generating, which is basically your retirement contribution, your Social Security, and your Medicare. The thing with an S corp is that if you're a Schedule C, if you're a regular no LLC single member, right? You make 100 grand in net profit, let's say, right? You're gonna get assessed income taxes on that 100 grand, but on top of whatever income taxes you're gonna get assessed, you're also gonna get taxed 15.3% on that 100 grand. That's $15,000 of taxes unnecessarily. So what an S corp does is like if you make enough money, it makes sense to switch. So in this case, if you make 100 grand and we convert it to an S corp, what the S corp says is like, hey, you have to pay yourself a reasonable salary out of your net profit, and out of that reasonable salary, that's what we're going to charge the 15.3% tax on. So if you take that 100 grand and you pay yourself, I don't know, 30 grand into like a reasonable salary, you're only applying that 15% on that 30 grand, which is 5 grand in taxes, give about, right? So you're saving 10 grand in taxes right there just because of where that 15% of tax gets applied, the 100K versus the 30 grand, right? So that's where you can start really saving the tax benefit. You shed that tax, that self-employment tax by a lot. The more you make, the more you can shed it, right? But that's where it makes sense to like see if it makes sense for you or not. Because if you're not making a certain amount of money, then it's gonna cost you more to switch than the savings that you're gonna get, because the tax prep services, the fees tend to be higher. Now you have to do payroll, pay a payroll provider, file payroll returns, do a better job bookkeeping because I need a full set of financial statements. So it involves all of these other costs that if the numbers don't make sense, I never advise my clients to do it yet. But if you're making a significant amount of money and it makes sense, 100%, you should do it because you're gonna be saving the tax.
And how much money do you suggest doing?
If you're netting about 20 grand or more, 20, 25 grand or more in net profit, that's when it might make sense, or at least it might make sense to explore the opportunity and the possibility of like, hey, can I convert? You know, under that, I think you're still smart enough where like the benefit that you're gonna see is like a few $100, 400, $500, which, you know, the like tax prep fees, the bookkeeping, all that stuff is gonna overrun it, you know, so you're gonna be paying more for this, right? So I wouldn't recommend it there. But when you're like past 20, 25 grand, then you can start saving like 2 or 3 grand in taxes. And that kind of offset. Even if you're saving 100 grand, you're still saving money, right? That's good because now you have the proper structure. Right now you're saving 100 grand, but you already structured this in a way where now you can scale it. You can go as high as you want, and you're gonna be saving more and more and more because the fees stay relatively the same, right? So that's where it makes sense. 25 grand or more. That's the sweet spot to really start looking to see if it makes sense to switch.